Hello traders, Gary Wagner here just after 10 o'clock in Honolulu, 4 o'clock in New York. It is Friday, happy Aloha Friday as we say on the islands, 16th day of October 2015, and this is the daily report for gold and silver. We have the precious metals complex under a little bit of pressure today when we look at spot gold currently trading 1176.64, putting it down about $6 on the day, and also trading just off of the low being 1174.50, high 84.56. Now, of course, when we look at COMEX, roughly the same, 76.20, although the net change is a little bit different, off about $11. Same low when we look at it, 74.30, and high 84.80. Now, just before recording the show, as I was looking over some of the charts and looking at the net price change, we talked about the fact on yesterday's show that we noticed a doji appear. A doji, of course, is when the open and close are either identical or very, very close, a couple of ticks apart. That typically is a consolidating candle and is simply telling us that neither the bulls nor the bears have absolute control of the market. Let's go ahead and pull up a daily chart. This is the doji that I am speaking of. This, of course, is yesterday's candle right in here, and it can be significant. It can also simply be a rest period, but it's certainly something that we want to pay attention to. As the market traded overseas, it was trading roughly in the 80s, low 80s, 81, 82. But as it moved into New York, of course, it began to trade lower and began to form what could turn out to be, and we'll have to see, but what could turn out to be that classic three-river evening star that it can be so predominant at tops of the market, either a three-river evening star or a variation of that. Here you get a harami, which is simply an inside trading day because of the location of this candle right here. However, it is long green candle, small bodied near the top, and then long red candle, and it certainly gave us a strong indication that the market was going to come down. Not so much here because you don't have the long green candle. However, you do see that V formation where we get the green and then converting to red. So it did seem to be a logical point to actually exit the trade. Now, the market could absolutely recoup and move higher. My sense is that we might see a little bit of backfill here. I'm still bullish overall, but I believe that we could be really at the beginning or onset of some sort of very, very small corrective period, what I call backfill in the market. And if that's the case, of course, we have a pretty good trade on. We got in at roughly 44. We got in right in this area as the market was coming down. We entered the trade at 44 and continued to raise our stops. Market did touch to a new high, that high at around 1190 plus. And it did exceed this prior high here. Of course, this was a lower high at around 54. So my sense was, in any situation, whether the market actually takes off from here, I have no problems buying an upside breakout. But if we were going to see some weakness come into the market, my sense is we wanted to pull profits on our trade. It's a nice trade and a nice way to end the week. Now, another way to look at this same data, of course, is to look at a Japanese average chart. Now, the market is still trading 1175.53. That's the current print, and that's based on true open, close, high, and low in a candlestick chart. On this, they're taking a midpoint, and they're tracking it roughly at 1179 in that area. As you can see, the body size, and realize that the Japanese average chart is always going to greatly lag behind any kind of move that you see in a standard candlestick chart, but you do see the first sign. There was a small tail here, which isn't that important, but the body size is absolutely diminished and contracted from what we saw on prior candles. So it gives us an indication that we could see some weakness come into the market. So traders have gone and converted it back to a candlestick chart. And here's what I'm looking at, and here's what my sense is in terms of where we'll see this market market go? We had a tremendous rally when we consider that this market traded roughly from 1100 up to almost 1200, 1190 and change. The fact is that when you get this kind of a move, you can see a correction. If in fact we do, I would look for absolute support. There's two main areas that we want to look at. One, of course, is 57. That's that prior top. And then the second is 1170, if it can touch to that point also, which is the top that we just took out in the marketplace itself. So with roughly an hour and a half of trading to go, we'll have to see where we close. We'll go into the weekend. But my sense is that we'll probably look to see where this marketplace does find support. We certainly are off the highs of 1190 at this point, some $15 shy of that. And so what we want to do now is basically look at a fib retracement of this last rally. Now, traders, I've done just that. I have added a basic fib retracement, and this retracement is starting at the beginning or onset of this rally, call it 1104, up to the top, call it 1191, and we get some interesting numbers. First of all, 23% retracement of this particular move would take the market roughly to 1170. Lo and behold, that is the top that we got here. The next level that we'd want to look at would be a 38% retracement, which is 1158. When we extend that line, lo and behold, we come up with the particular price point of this particular top, just above this particular top here and these highs here. So it tells us that these are important numbers, and if we are going to see this market continue to backfill, if it's going to show any more signs of weakness, we can look for it to move either to, call it 70 and pop back up, or back to this prior top right here at around 57. That would be the end of that corrective wave. I think this will be a shallow wave, and from there we should move to higher ground. So traders that took the call at 1144 got out roughly at 1177, 1176. We sent it out when the market was just touching at around 1177.91. That's where the chart shows. So somewhere in that area, we'll mark ourselves out at 76 or 77, but in at 44, out at 77 for a nice profitable trade to end the week. Lastly, I did also suggest that if you're going to pull profits on our gold trade, our palladium hasn't really amounted to much. Market currently trading at around 697, putting it off about $8 on the day. But my sense is if we're going to see the precious metals complex under pressure and gold under pressure, we could certainly see follow through in palladium. We will take a small loss on that, in at about 706. Out at 98, so about an $8 drawdown on that, and realize that's 50 ounces per contract, so you're looking at $4 drawdown if you compare it to the 44 price in and out in gold. Nonetheless, a nice trade in gold, small loss in palladium. This has been Gary Wagner, wishing you as always good trading. We will talk to you on Monday for another daily update and review. Bye-bye.